there's a couple of factors that lead me into believing that the worst is behind us. Most of the forced selling is over, right? Any funds that needed to unwind before year end have largely done so. There's not nearly as much leverage in the market. There's also really a very difficult to short anymore, right? FTX was one of the easiest places to short the market, as well as getting loans from places like Voyager and Celsius and BlockFi and Genesis, all of which are now defunct. So it's hard to short the market. There's a lack of supply. I think that is encouraging for a bottom, but also, generally when investors are all on one side, and for the last few months, everybody was negative, everybody was high cash balances, everybody was short, you start to see negative news no longer matter. And I think that's what we're seeing now is most of the FTX dump has retraced. You're seeing negative news about DCG and Genesis and Nexo, and the market just doesn't care anymore. Probably my biggest thesis with regard to this is that we're going to continue to see an onboarding of Web 2 and other corporations coming into Web 3 and DeFi. Companies that have been around for 50 to 100 years are starting to utilize blockchain, right? We've seen financial companies like KKR and Apollo start to tokenize funds and securitizations. You've seen Goldman and JP Morgan and BNP start to get involved in some DeFi transactions. And then you're seeing on the NFT side, you've seen companies like Nike and Starbucks and Reddit start to adopt NFTs and start to find different product lines and revenue enhancing functions there. And what happens is, you look at the total digital asset market, there's only, estimated 200 or 300 million people who have ever really interacted with the blockchain. That's smaller than some of these companies I just mentioned. I mean, Visa alone has 200 million users, right? Apple and iTunes has 300 million users. You start to port over, Starbucks has 60, 70 million users. You start to port over some of these user bases that already exist in the non-blockchain world, and you start giving them blockchain tools. So I think when we see that, that's going to be a massive catalyst to the upside, certainly for layer ones and layer twos, but ultimately for DeFi and for NFTs and other projects. So Bitcoin has definitely been very correlated to traditional markets and to traditional macro factors, and largely because Bitcoin has just become a 24/7 VIX, right? It's just a trading vehicle now for large funds who want to get in and out of risk, on weekends and overnight trading hours. So I don't think Bitcoin's correlation to the market will go away. But the rest of the market decoupled back in May. Again, the first 4 or 5 months of the year, every single market was being hit by the central bank policies and by the speed with which central banks were raising rates relative to expectations and the fact that inflation was much stickier. But the digital asset market decoupled in May. When Terra Luna blew up, the digital asset market got crushed, whereas the traditional equity and debt markets didn't move. And that's because that was a very idiosyncratic event that was specific to Luna and UST. Now, we decoupled to the downside, not the upside, so most people don't want to admit that was a decoupling because everyone wanted us to decouple up, not down, but we decoupled down. And then in July and August, when the Ethereum 2.0 merge roadmap became reality, we decoupled to the upside, and we rallied pretty hard because of Ethereum. That, again, had nothing to do with macro. There's no reason to lump all of these assets in the same category just because they're all digital assets. When you look at Ethereum and you look at Polygon and you look at Solana and you look at FTT, their returns had nothing to do with macro. FTT went bankrupt, right? Solana basically went down 95% because of its ties to bankrupt and failing entities. Polygon went up, and that leads into really what I wanted to get to, which is most investors 3 years ago, 2 years ago, even last year would say, okay, I'm starting to believe in blockchain, but I don't believe in tokens because tokens have no intrinsic value. I want to own equities where it's safe. Okay, well, how'd those equities do? How'd your equity in BlockFi do? How'd your FTX equity do? How'd your Coinbase equity do? So in equities, what drives the value of equities is if you're a going concern, meaning if you're a company that's not bankrupt, it's the multiples that you can get on your revenue and your cash flow stream. Well, if we head towards a recession and we have higher rates, well, two things happen, right? Those revenues and those cash flows go down, and the present value of those cash flows go down because of higher rates. But also, you may have trouble refinancing your debt, and you might end up in bankruptcy, where all of a sudden your equity gets wiped out in a liquidation, and creditors take over the new equity of the reorg business. Well, that's very different from tokens, right? How do tokens generate their value? Well, there's two components. One is a financial value, very similar to stocks, right? If you look at the revenues and the fees of Ethereum or a Uniswap or a Binance or any of these companies or projects that have real revenues, there's certainly a financial component to the value of a token. And if those financial values go down, then those tokens will go down. But the other component of a token's value is the rewards or the loyalty or the usefulness or the utility of it. That doesn't go away in a recession. So I think we're headed into an environment where you're going to see a lot of stocks get punished under the weight of restructurings and under the weight of lower revenues and lower cash flows. And you're actually going to see a lot of tokens do really well. 3-4 years from now, you might come out of this and be like, actually, 2022 was the year that everyone realized that decentralized finance just works better than traditional finance, right? Code works better than humans. Humans make mistakes. Humans are greedy. Humans do things and cut corners. Code doesn't do that. I think probably the most important thing is when you look at each of the companies that have gone under this year, there is a DeFi or decentralized substitute that does the exact same thing with the exact same customers that has flourished, right? Again, for every Voyager and Celsius and BlockFi, there's a Compound and a Maker and an Aave that are doing really well. For every FTX, there's a Uniswap or a DYDX or a GMX that trades the same instruments. Ultimately, when you look again where DeFi was 2 years ago when DeFi just started, the spot trading of digital assets was less than 1% of total volume. Now it's 12%. That's a big jump over 2 years, and that's largely because of the success of Uniswap and some other aggregators. You're going to continue to see that shift happening where more and more people just get comfortable using these decentralized alternatives. I think with record numbers of hacks and exploits and bad actors, there's no question that we need more rigorous security and testing practices. The test in prod is not going to work. Whether it's products that offer simulation stress testing for DeFi protocols or just greater security of private key storage or more transparency around where your assets are. These are initiatives that are basically going to have to be taken much more seriously in 2023 and beyond. And there are companies and projects that are attacking. Bitcoin still has a very large overhang of supply from the inflation rate and from the miners. On top of that, you have, again, Mt. Gox distributions, you have government seizure distributions, you have a fair amount of collateral still held on lenders and bankrupt entities that might eventually get sold. The number I estimate is about $11 billion of supply is going to come out for Bitcoin next year, or this year, 2023. That basically means you need $1 billion of buy pressure a month just to keep Bitcoin flat. That's a lot. That's a lot of demand. Ethereum is, basically because of its transition from proof of work to proof of stake, is now certainly disinflationary and in some cases even deflationary. I think in the last week and a half, it's been deflationary. There's been more Ethereum tokens burned than there was new ETH issued that flows to stakers. That's a big supply-demand dynamic. Now, all else equal, Ethereum can be flat even if there's no new demand just because the supply is being burned. That's a big deal. And then on top of it, Ethereum has, real revenues and cash flows that come in. You can think of Ethereum as like the Apple App Store, right? The more people who build in the App Store, the more transactions, the more volumes, the more revenues that go to Apple. Same thing with Ethereum. Then you also have your utility function, which is you have to still use Ethereum in the ecosystem, right? It is a currency within its ecosystem. So I just think the usefulness, I look at everything from a financial modeling standpoint and from a growth standpoint, and Ethereum just has more usefulness. It has more revenues and cash flows, and therefore I think it has more likelihood of outperforming Bitcoin.